The Dow, of course, ended the day down nearly 800 points. Yields on bonds sank, in fact, below 1% right now in the 10-year. Oil rose, but oil stocks actually fell, bizarrely. Crazy times anyway. But the key question for you is this. Is the market pricing in a recession, or is it simply overreacting to an irrational human fear of something we don't understand, the coronavirus? Let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Mike, just a light question there. I know it's nearly impossible to gauge. We appreciate you joining us. Has the stock market overreacted?
Well, no, I think we have to kind of acknowledge that. I think what's going on today is just a continuation of the correction that began actually 2 years ago. And I was listening to some of what you were saying at the beginning of the show, and I agree with a lot of that. I mean, with the fourth quarter rally was really somewhat nonsense, and we've talked about this. I mean, it was really liquidity induced. I mean, there was some hope that, growth was bottoming, and we were looking forward to something better in 2020 from a growth standpoint. But the moves that we saw were just completely unjustified by what we're seeing in the fundamentals. And so we've been, expecting that was an overshoot. We didn't know when it was going to recorrect, but we think this is overdue. And the reality is that on the virus itself, I mean, it was going to be that or something else. Obviously, this is a little more scary, perhaps, for markets. That's why it's more violent. But what I think is going on is that this is really the fourth shock that we've had now to the economy in the last couple of years. The first one being the fiscal stimulus, which caused cost problems and margin issues, which we've been writing about for 2 years, and there's still an earnings recession going on right now, and that's still a headwind. The second thing is that the Fed actually did raise rates a lot in 2018. They had a full rate hiking cycle, and that's still having a negative impact on the economy from 2 years ago, quite frankly. The third shock was tariffs. And yeah, we have a phase one trade deal, but the reality is that there's still existing tariffs that are out there. And now we have a virus, which, by the way, is a direct, concern for the U.S. consumer, who's been the linchpin for the U.S. economy. So I think it's right that the market is starting to price in a recession. I mean, the bond market's been telling us this for a long time. Cyclicals have really underperformed, and we've been, very bullish on bonds and, utilities because we thought rates were going to go lower. But I'll tell you, I mean, today's move is startling in that regard. I mean, we never thought we'd be at 1%. But look, I think it all makes sense. And now, so the question we have to ask ourselves is, how much recession has been priced? And we think, a good chunk of that's been priced. But until there's certainty about how this is going to resolve itself, I think we're going to remain under pressure.
Hey, so Mike, it's Dan. Quick question on valuation. Last year we saw obviously a multiple expansion, 30% up in the S&P 500, no earnings growth. This year we have the S&P now down 7%, and the likelihood is that we won't see a lot of earnings growth, if any. So where is a valuation level that you're kind of steering clients towards? Again, not knowing, there's no visibility on S&P earnings here, but relative to where they were high single digits just a month and a half ago.
Yep. So, we've had a little bit, more bearish view on earnings even before the virus. We've been looking for flat earnings growth this year because of that margin pressure I talked about before and some lingering effects from tariffs. We were not that excited. But now I think that's probably got downward pressure to it. I would say maybe it could be slightly negative. The consensus, as you're saying, I think is still +7. So we think there's about 10% downside to the consensus numbers. Now, the market is discounting that, right? That's why multiples have come in. And with rates as low as they are, the equity risk premium is actually as high as we've seen since really, last summer or December of 19. But I think you guys were talking about this earlier. When rates get this low, you might argue that the equity risk premium might have to go up even higher, because with rates at 1%, what is that really saying about the longer-term future? And the market's going to struggle with that until I think real rates start to get back towards zero. And so what am I saying? I'm saying that I think that we're at fair value today. I think this is actually, the market's discount a lot of bad news, assuming rates normalize. But if rates don't normalize, I would suggest that we could go down another 10% or so.
Mike, it's Karen. Let me ask you something. If you think we're on the cusp of a recession, and you have to be invested, what are you telling your clients in terms of where they should be? Is it utilities? What are the most defensive things you have them in?
Well, we've been there, and those are now really expensive. So I think the market has already moved well ahead. Like, it's been preparing for this for a while. And, once again, I think these increasing shocks have been happening for a while. And I think the Fed last summer, I don't think those were insurance cuts. I think that was the beginning of the rate cutting cycle. And now we're moving into the second phase of that. And so what should clients be doing now, and what should investors be looking to do? Look, I think the biggest risk in the market is still in these high multiple growth stocks, that are overowned and overloved, because they are not pricing in any kind of recession risk, okay? And look, that's not our call yet, just to be clear. We're not saying there's a definite recession, but the earnings are going to have to come down for all of these companies. And I think those are the areas I think you need to avoid more than worrying about, hiding out. And I think this is an opportunity to upgrade the portfolio. There are some things that have gone on sale, and we've been trying to do that in our focus list, buying high-quality stocks that have come in 20% or so. And I think that's what you should be doing. You should be upgrading your portfolio into this decline because we don't know exactly where it's going to end.
Mike, give us 2 or 3 of those names. I mean, that's really interesting stuff. What are the highest quality names you want to buy on sale?
Well, something that we just added this week was MasterCard, right? Because it had corrected a lot. We added that to our model portfolio, and I think that makes perfect sense. And that is a growth stock, and it's one of those ones that's kind of overowned. But they have a great business model. But that's something that rarely goes on sale, and there are examples like that I think make sense. The other side of the equation is to look at things that are really cyclically beat up. Okay, so some of the banks, they have been destroyed, and they probably are going to be a little more pressure, but banks and maybe some of the materials and energy and things like that, because on the other side of this, if we have a recession, there will be a rebound. Like, we're not secular bears. We actually think that we're going to manage through this at some point. And that stuff has been selling off now for almost 2 years or 3 years. And so there are some bargains in the cyclical area that you should be starting to take a really hard look at here.
Mike, you think the snapback can be violent like we saw yesterday?
Well, I think that's a classic bear market rally type action, right? I mean, that's the kind of stuff I don't want to see. I'd rather see us stabilize, find a level. I think you guys mentioned 2850. That was a level we published in our note on last week, as well as a level we thought that it would hold. I would say I'd like to see some basing out. I'd like to see volatility come down as opposed to this whipsaw up 1,000, down 1,000. That's not healthy.
Mike Wilson of Morgan Stanley. No, it is not healthy. We appreciate you joining us, so thank you very much. A healthy dose of reality there. Did anybody around this table buy anything today? Volatility?
Puts.
No.
Puts?
Well, listen, here's the thing. I think that what Mike said, there's going to be opportunities because of this volatility. I just think you got to pay attention. New York Times, they took down their advertising revenue for the quarter. How do you extrapolate that? Did you see Facebook close down 5.5%? They get 90% or 95% of their sales from advertising. Does that put Google? They haven't pulled their guidance yet. So you got to start putting some stuff together. It's like a big mosaic here. Things are going to get ugly for a bit, but the stuff that you love is going to give you an opportunity to buy it on sale.
Start to get a shopping list.
I will say, look, we actually did nibble on a couple of things this morning for a couple of clients, because the discipline that I certainly have been saying, I was saying it Friday, at some point, you do want to be stepping in here to buy some stuff. I think casinos got very cheap. I think you had a case where, there are certainly names that we have been waiting to come down to a place. I also, though, hate buying on a Fed day. So we had a little bit of both today. So after that Fed move, it was kind of like we need to stand back, and we've all said it. And I'll remind you again of 2011. You had this period, massive drawdown like we had. Then the market did this. It chopped around in plus and minus 5% moves for almost a month. I think we're in a difficult period here.